Matt Orton, Raymond James chief market strategist, joins us now with his outlook for stocks into next year. Matt, thank you very much for joining us. So volatility, we saw basically two spikes this year, one in August and one in mid-December in terms of volatility. If we do get higher volatility in 2025, how should investors be preparing for that now? Is it something where they should be opting for some kind of volatility hedge, diversification, buying on the dips when they see volatility? What are some of the playbooks that you would advise?
Good morning, Leslie. Great to join you on the last day of 2024. And I think when we have a higher volatility bull market, we're already seeing that play out over the past couple of weeks as we head into the end of this year. But the fundamentals underpinning this market are still very, very solid. I'm looking forward to strong earnings growth that's going to continue to broaden out across sectors. And so I think when you have a strong fundamental basis for the market and the economy as a whole, I would be looking to use any sort of meaningful pullback in the market as a buying opportunity. I tell all of our clients when you have those meaningful pullbacks, particularly the one that we had over the summer, you should be using downside opportunistically to lean into better diversifying your portfolios. I fully expect growth and value to both work pretty well next year. So there's an opportunity to maybe take some profits on your winners and make sure that you have a portfolio that can better weather some of that volatility and also some cash that you can continue to deploy throughout the year.
Despite the earnings growth that's expected next year, the market is still trading around 22 times those projected earnings, above the 10-year average of 18.5 times. So what does that tell you about how much more upside or expected returns that investors can hope for from here?
Yeah, you know, Leslie, I don't have much of a concern about where valuations are. I get asked by clients all the time about whether or not this market is too expensive. And for a long time, I've said it's not. And I think you can use the past 10 years, 20, 30 years, but the market and economy itself have markedly changed over that time period. The market has become growthier, part due to mega caps, also part due to just long-term secular growth shifts that we're having. And as a result, you know, as the market has become growthier, you should be willing to pay a higher premium for it. And a lot of the companies that are more expensive have been delivering earnings. So I'd much rather own that growth with companies that are delivering solid free cash flow, consistency with respect to EPS increases, and that's where I'd want to look. And I think that's almost where small caps are going, which is an area that I like a lot moving forward. You know, small caps aren't all low-quality companies. We're going to be seeing, I think, an inflection with respect to earnings heading into next year, and they are trading cheap, and I think they can support higher multiples, particularly relative to large caps. So there's definitely plenty of opportunities, even if you're concerned about valuation.
You know, Matt, one of the elements of this rotation or this hoped-for rotation into smaller stocks or into the broader list of stocks or cyclicals over the course of this year has been a little bit of confusion about where we are in the cycle and what the character of this economic cycle is. 1 year ago, I think economists, the consensus was there's like a 40% chance of recession. There really was a very high level of concern about whether the expansion could continue. Obviously, we climbed that wall of worry. The soft landing has seemed like it basically is manifest right now. We don't really have a similar level of concern right now, and yet we also don't have those kind of early cycle dynamics where you might expect things like cyclicals and riskier and lower quality stocks to perform. So how do you navigate all that?
Yeah, it's such a great point, Mike. And I think what's confused so many investors and many of our clients alike is that you basically thrown the traditional book of economics right out the window. And I think that's because we've never had zero interest rate policy persist for such a long time. And we're exiting an unprecedented monetary environment regime along with high fiscal spending. And so I think you can't expect a lot of those long-term economic theories to work out in the short term. Long term, sure, I think we're going to revert back to that, but I don't think we're there yet. We're still working through fiscal largesse. I think that's still going to support the economy moving forward. We're moving into an environment where the market and investors are hoping for a better regulatory regime moving forward, which I think benefits financials and benefits smaller companies. So I wouldn't focus so much on what the market should be doing relative to what economic theory tells us. I'd be looking at the fundamentals, talking to management teams, listening to what they're saying about the state of their consumers and about their growth going forward. And when I put all of that together, I get a pretty optimistic picture, which is why, going back to where we started with Leslie, I think we can use downside opportunistically because nothing right now is telling me about this whole mosaic that when we see downside, something more pernicious is lurking in the background.